Welcome everyone today to our webinar, Tax Update for California Schools. Before we get started, there are just a few housekeeping items I want to address. So first is you can maximize or minimize the webinar pane during the presentation by using your red or orange arrow buttons. During the webinar, we definitely encourage you to ask questions. In the webinar pane, you'll see a questions box that you can use to type in your question, click submit, and our presenters are going to be answering those questions as time allows. We also want to make sure everyone has good audio quality. So if you're using your phone today, make sure you select the phone call audio option. And if you're listening on your computer, make sure you select the computer audio option. And if you're joining us here today for CPE, just a few reminders, you need to be on your own personal computer, no smartphones, and logged in with your own unique URL. Be logged into our online software for at least 50 consecutive minutes within the scheduled time frame. Actively respond to at least 75% of the polling questions. Today, we're going to have 4 polling questions, so you must answer at least 3 of them, and complete the evaluation survey at the end of today's webinar. As a reminder, we will have the slides available and a recording of this webinar up on our website within 48 hours. Today's learning objectives are to assess the direct and indirect impact of the Tax Act and other tax regulations on California schools, review specific examples on how to keep your schools in compliance, and evaluate reporting challenges for schools in 2020. And with that, I'll go ahead and pass it off to our presenters.
Good morning, this is Martha Ambrose, and I am the Executive Director of Cal-ISBOA. You know, a large part of my job is listening to our members and sort of what concerns they have and what interests they have, and obviously tax compliance is a big one. And because we're in the state of California, although these are, you know, federal regulations, we have a different, sometimes we're affected by them differently. And so every year we talk about how we can get an update. And this year, just in talking to Armanino, we decided it was a good time. There was a lot of activity and there were some evergreen topics that come up every year, multiple times on the listserv, that it just seemed like a very relevant time with all the changes that have been going on. And so I am now going to turn this over to our experts at Armanino. Dean?
Hello, everyone. Thank you for joining us. If I haven't had a chance to meet you, we definitely look forward to that. Armanino, we work with a ton of schools in California. It's our home base, and definitely happy to bring this update to the California schools. And I think we can go to the next slide. Oh, wait, I did have one more thing to say. That's exactly what it was. The last thing I want to say is I can't wait to see everyone in Orlando in right around 30 days. Hopefully we'll see everybody in Orlando at NBOA and at the California Wine and Cheese event.
Hi, this is Katie Brown. I am a tax partner and I am the lead of the nonprofit tax practice for our West Coast offices. I've been working with Cal-ISBOA for a couple of years now and looking forward to seeing everyone both at NBOA and then in May at the Cal-ISBOA conference.
And I'm Matt Petrosky. I'm the newest member of Armanino. I'm a tax director here working with Katie and the rest of our group. Spent my entire career in the Big Four in the nonprofit space. So looking forward to meeting everyone next month.
All right, today's agenda, all things tax. Matt and Katie have promised me that we are going to stay as riveting as possible and not get too much into the technical, but hey, let's face it, so much of tax is technical. But yeah, we are going to talk about the repeal of parking and commute benefit tax. Thank the Lord, right, Matt? Thank the Lord. All right, we'll get into some UBTI. We'll talk about compensation and what we're seeing there. We are seeing some tax exempt financing issues in the nonprofit space. It could impact private schools, especially with regards to private business use. We'll touch on Section 529 plan funds for tuition, and then Schedule E non-discrimination policy. We want to make this as engaging as possible. So what we want to do is, if you have questions or as they come up, please feel free to type them in and we will try to address them as current and as live as possible. So with that said, let's get going.
Great. So I appreciate having the, I call it the happiest slide in the deck. I get to talk about the repeal of the parking and commuter benefits tax. So as we all know, this was originally in the Tax Reform Act that happened in the very end of 2017, and many hours since then were spent analyzing, trying to figure out what that meant and how organizations were required to implement it. And thankfully, on December 20th, we found out that was included in the spending bill. And so the repeal happened. When I first found out about it, I went straight to the statute and what the legislation, the legislation actually said, expecting really something grand, given how hated this bill was. But it simply stated Section 512A is amended by striking paragraph 7. That was it. So I felt like it sort of went out with more of a whimper than a bang. But I think we can all be happy that it was retroactive, which means we can treat it as if it never happened. I think we'd all like to think that way, but it did happen, but now fortunately it's gone. And we can go back and amend returns. The IRS just came out with guidance last week as to how organizations can receive any of the taxes or penalties that they paid. Everyone was hoping for some sort of easy way to get a refund besides going back and amending, but unfortunately, that's really all that the IRS has stated is available. What we do know is that there was bipartisan support for this repeal. I think we were a bit surprised that it happened when it did. There had been, I know, of at least 6 legislative attempts to repeal over the years, and they all failed. Generally, it was because there was a lack of a pay for. Everything that went into that original 2017 legislation had to balance out so that otherwise it wasn't able to get through. And even though the parking wasn't significant relative to some of the other taxes, in order for the repeal to happen, they still needed to figure out how to counterbalance that lost tax revenue. I think one of the big takeaways that I think we can all say is that there was significant pressure from the industry, from all sides. It was pretty clear that the industry felt like this was bad legislation, that this really, even though the goal was parity between nonprofits and for-profits, that really wasn't appropriate in this instance. I do say, really highlighting that what moved the needle especially was when certain individuals within Congress understood that it would impact churches. So I think that they did sort of couch it as a tax against churches. And even though that may not have been what impacted our organizations, I think it was something that really had an impact on certain people within Congress, and they made sure that this was actually repealed. So as much as we'd like to say we never analyze your parking lots again, keep my fingers crossed that this never happens. But you know, obviously, unless you rent them out, then maybe you're analyzing on the UBI front. A few issues that I just wanted to highlight that probably won't impact many of the schools here, but some issues that some organizations are thinking about. Some organizations actually, if they were particularly in an urban area where they provided pre-tax parking, some organizations, I saw some universities go post-tax to try and avoid this. For organizations that want to go back to pre-tax, unfortunately, that is not retroactive, so it will be taxable during that period to the employees, and that cannot be changed retroactively. We are thankfully in California that did not have state conformity, so there was no California UBIT that had to be paid. But any organization that maybe has parking lots, organizations outside of California where there is conformity to a specific date, those organizations are in a bit of limbo because until that gets changed, those the state UBIT still exists.
All right, Matt. So big picture here is that this is repealed if you paid the tax,
Yes.
file an amended return, and you should expect a refund.
Yes, and there's very specific, the IRS sort of laid out, here's how you do it. It's pretty simple, straightforward. I know we had a tax alert kind of running through that about a week ago, but it is a straightforward process.
Okay, good. Well, then if you paid the tax, let's get your money back, right?
Yes.
Okay.
Sweet. And with that, we'll go into our first polling question. Just as a reminder, you need to answer at least 3 of these during the duration of our webinar. So does your school have any unrelated business income generating activities? Yes, no, not sure, need to review. We'll go ahead and give everyone just a few seconds here to get your answers in. And we'll go ahead and close the polls.
This is like a trick question.
So it looks like most schools said no, 54%.
So we see a lot of schools that say no. Now let's go through these slides. It's almost like we wish, Marie, that we can say, all right, let's do a before and after poll, because after we go through these, maybe some things will happen. But these are all some good information here, Katie. Let's take this away.
Yes, and of course, parking doesn't count anymore, which is great news.
Yay.
So in looking at unrelated business income, there were some changes in the Tax Cuts and Jobs Act that do affect organizations that have UBTI. One of the big ones was Section 512A6 was enacted, which says that different UBTI activities can't offset each other. If you've got gains in one and losses in another, they have to be siloed. So we have to treat them separately going forward. So this is effective for tax years 2018 and later, which means for most of us, if we're on a June 30 year end, we're looking at our 6/30/19 tax year. So this would be the first year it would apply. There was a notice issued back in 2018 to kind of give some guidance and ask some questions about how this would be reported. They were asking for public opinion on how the rules should work in terms of how activities are grouped together. Some suggested using the NICS codes or maybe just the first 3 digits, but they did not get any more specific than that, and they haven't issued any guidance subsequent to their request for comment. So at this point, we're still using our best efforts to separate those activities. One thing that they did say specifically was that if you have partnership pass-through UBTI, so if you have investments in a partnership and you're receiving a K-1, as long as you have 2% or less ownership, which is considered de minimis, or if you have a lack of control and 20% or less ownership, we can group all of those activities together. So if you have 10 different K1s, we can group all of those together as long as you don't control any of those. For other activities, we're basically looking at it on a facts and circumstances basis, and we're trying to see how related are these activities. Obviously, we generally are going to prefer to group them together, but to the extent that we have to separate them, we will do that going forward. And this also applies for NOL purposes. So if you've got one activity that's generating a net operating loss, it can only apply to the activity that generated it going forward. In the past, all net operating losses were applicable against all types of revenue. Could we go to the next one? So this works in conjunction also with a limitation on net operating losses. Under Section 172A, we can only apply net operating losses to 80% of our taxable income in future years. So the net operating loss generated by one activity can only apply to that activity, and then also only to the extent of 80% of taxable income in future years. Section 172B eliminated the 2-year carryback provision, so now all NOLs will automatically carry forward. That has been the case in California for a little while, so we're finally kind of on the same page there. And we've got a 20-year carryover period. The law also eliminated the corporate alternative minimum tax, which is great news. If you had that hitting you, there were other limitations on your net operating losses that you weren't allowed to take that don't exist anymore. And again, this is effective for 2018 tax years. So if you had net operating losses generated in a 2017 tax year or earlier, you can still apply it to all of the different revenue streams that you might have. But again, the carry forward is limited to 80% of taxable income. And when we are looking at schools, there are a few other common sources of UBI that we see. One of the most common is advertising. So generally, advertising is considered a taxable activity per se. The difference between advertising and a qualified sponsorship has to do with the way that the information is presented. A qualified sponsorship, you can accept money from a sponsor and have their name listed. You can have a picture of their products, but you don't want to say anything qualitative, you know, best hamburger on the block, anything like that is going to be considered advertising.
What if it's like, Katie, what if it's like the official, you know, a lot of our schools have, you know, maybe their sports teams are, you know, they're Nike or Under Armour or something like that, and they say the official, you know, whatever, athletic apparel of XY school. Does that matter?
That is okay, as long as we're not saying that it is the best or there's no call to action. You know, Under Armour supports our school. Everybody go buy Under Armour. As soon as we get to that second sentence, everybody go buy, it is advertising. So
Great.
you
Good
can
insight.
you can let people know who your sponsors are. You can post their contact information, but nothing qualitative and no calls to action.
Great.
Another really common area that we see is, again, pass-through UBTI on partnership K1s. If you have a K1 that's generating ordinary income or anything that is listed as UBTI on the K1, we need to look at those, and most likely you'll have some taxable income there. In some cases, private business use of tax-exempt bond finance property can also be taxed as unrelated business income. We'll talk a little bit more about private business use in a minute. Rental of facilities that include significant services. So if you're doing event planning services, setup and breakdown, any kind of, you know, ongoing IT services or broadcast services or anything like that, if that's included in your rental contract, that can taint your revenue stream and make it taxable.
What about a lot of schools are renting out their facilities, whether it's to the summer camp or to another entity for sport camps, or maybe they rent out their theater. What about those types of operations?
So generally, if you're only leasing real estate space, so just facilities, no personal property, no services included, it's going to be non-taxable for schools. If there are significant services, or if personal property represents too large a percentage of what you're renting to somebody, it can become at least partially taxable. So if you've got any of those kind of situations, please feel free to reach out to us and
so just to, let's put meat on the bone here. So the definition of a significant service is what?
Anything that is not incidental. So if you're providing additional security after hours, if you're doing event check-in and monitoring, if you're doing event planning, let's say you've got a wedding that's coming through and your employees are actually doing the planning services, those kinds of things that are not considered significant, taking out trash after an event, anything that would be going on anyway. So if you've got security during the day and the event is happening during the day and there's no additional input from the school, those would be considered not significant. But anything that's really pushing the line of helping to coordinate and put the event on is going to be considered significant.
And then that would make the rental a potential UBI situation.
Yes, that is possible.
Okay, great.
Any type of sales that are regularly carried on. So I know lots of schools are selling things like uniforms or PE uniforms, things like that. That's not really what they're looking at. But if, you know, you've got, let's say your art classes are generating art and you're selling those to outside sources, and that's something that you're carrying on regularly, that's a normal activity for you, there is a possibility that the net income from that activity could be taxable. So we always want to have you look at those things, and if you've got questions, we're always happy to help. Also, gaming that is not a qualified raffle or qualified bingo is also taxable income. So if you've got bingo that is not a typical, called out number kind of bingo, if you have pull tabs or any kind of instant win, net income from that activity is going to be taxable as well. And that's something I think it's pretty easy to forget. But
Katie, before
something
we
you
move on
can't forget.
to the next slide, is there a threshold of when these areas of UBI are required to be counted?
No, generally no. There's not a de minimis amount. There's not a materiality threshold. You get the first $1,000 of taxable income for free, but after that, we have to go ahead and file and see what your liability is.
Yuck.
Yes.
So really what it means is if you're going to have to file, it means you're going to have to track. I think that's the most important thing, right? Is that you're going to have to track income and expenses so that you know what's going on by each different type of UBI. That's essentially where you start.
Yep. So in the past, we used to be able to aggregate them, but now we really need to keep the expenses separate per UBI line so that we can make sure that we've got the correct net income for each type of UBTI that you might have. And so we know that we always reported on 990T. We're all a little bit sick of seeing that form, I'm sure. But there are new schedules that allow for us to silo. They look a lot like the first page. They're called Schedule M, but we are basically tracking each activity on a separate page, and the net operating losses will get tracked that way also. Everything gets combined together and you get that $1,000 specific deduction, which is what I was saying, you get the first $1,000 free. And then if you do have to make payments, once you make a payment of $500 or more, you're required to pay online through EFTPS. Again, some of you probably had the wonderful experience of getting that set up in the last couple of years. So you're familiar with it, but it allows you to schedule and make payments online. And then you generally have to set it up at least 10 business days in advance of being able to schedule online payments. It takes 48 hours if you're going to do it over the phone. They have a voice response system. And then if you're expecting your total liability for the year to be $1,000 or more, you're required to make quarterly estimate payments to avoid underpayment penalties. So again, if you have questions on any of these items, if you're wondering, is this revenue stream that we have taxable? Would we have a filing requirement? We're always happy to help with those types of questions.
And Katie, we did receive one of those questions. Are yearbooks taxable?
Ooh.
Yearbooks generally no, because that's going to be something that's carried on by the students themselves. Typically, there's a yearbook committee or a yearbook club that puts it all together. They're selling it to other students. That's generally not going to be unrelated business income.
Great.
Unless you have crazy advertising in it, right? Which could generate some income.
Yeah, I mean, we should maybe, this is such a hot topic, I believe, that, what are some of the examples? Obviously, we won't name schools, but I'm thinking about the fundraisers or the different items that, can be very lucrative to schools, but have resulted in UBI. Is there any examples that come to mind here?
Sometimes, let's see, advertising is a big one. It's easy to accidentally, think you're taking a sponsorship, but then you end up actually posting an ad, and that has caused problems. Online advertising is another one that, you put somebody's ad up on your website and all of a sudden that's taxable. Those are some of the more common ones. And then honestly, as people get into more exciting investments, trying to find a better investment return, considering how rotten our interest rates have been for so long, getting into alternative investments, well, oftentimes it can generate a lot more in revenue. You end up with taxable income and then also compliance costs, which
what
you don't
about
want to think about.
What about real estate? I mean, I know we have a lot of schools that, we have a lot of schools in California that are landlocked and they're acquiring real estate around their school or areas around it, or maybe they're just taking operating reserves and picking up real estate and operating a portion of it and renting a portion of it. What are our thoughts on that?
So there is a rule about unrelated debt financed income, where if you have debt on real property and you're renting it out to somebody, to the extent that it's debt financed, it is taxable for most organizations. Schools have a pass on that. There's a special exception for schools and churches and retirement plans where if you have debt on a building and you're renting out a portion of it, typically as long as it's not any significant services and not a substantial amount of personal property, which is anything that's not part of the building, so chairs, tables, AV equipment, all that kind of stuff. As long as it's a clean rental where they're coming in and using the space and then returning it to you in that same condition, that's generally going to be excluded from taxable income for schools. There are some cases where if it's tax exempt financing, there can be taxable income from those rentals in addition to private business use. But again, we'll talk about that a little bit more in a minute.
Great. Is there another question? Or are we good?
There are a few questions. I think to the extent there are any detailed questions and we can get to it at the end, we'll follow up. Otherwise, we will follow up with the individuals that have asked the specific questions.
Awesome. Then with that, we'll go into our second polling question. So does your school offer tuition remission to employees? Yes, some employees are eligible. Yes, all employees are eligible, or no tuition remission plan. We'll give everyone just a few moments here to answer. And we'll go ahead and close the polls. So it looks like the majority of people answered yes in some form. Either some or all their employees are eligible.
Okay, let's dive into this. This is some interesting things here that we're seeing schools do. So Matt, let's kind of dive in.
One of the areas that we do see issues arise are in the compensation area. So anything related to compensation and any benefit packages that are provided, obviously it's everyone here is really often in a struggle to find that top talent and to retain the top talent. One thing that we see a lot of our schools provide is tuition remission. So the Internal Revenue Code allows schools to provide essentially that tuition benefit to employees and their children tax-free. But the key caveat is they cannot discriminate in favor of highly executives or highly compensated employees. There is a very mechanical test to figure out whether the plan violates that. So it's a 7-step calculation. So I think that's one thing to take a look at. And really where we see this as you provide the staff maybe a 50% benefit, but the top executives get 100%. So things like that might cause an issue. I think if everyone is provided the same benefit, generally there wouldn't be an issue. So I would say take a look at your plans. Are you providing more than one? Is there a business reason to do so? And then have you determined whether that plan is discriminating in favor of the highly executive employees. Really, the only issue would be for those executives that fall within the highly compensated definition, their benefit is taxable. Then another area we see is the non-taxable housing. It can be provided as a condition of employment. There's a very specific rule around it being for the convenience of the employer, required as a condition of employment, and basically it's on the premises. So take a look if you're providing housing to the president or anyone within the organization. Do you believe that it should be non-taxable? And if not, is there a component that should be taxable? Making sure also that there's a reporting component as we look to the Form 990, reporting of the non-taxable benefits, that would be included there as well. Some of the other areas we see are if certain executives, maybe the traditional retirement plan that is provided to all employees might not be enough for those top executives. There are some other ways to provide them additional retirement benefits. That could be through a 457B plan or a 457F. So the 457F sometimes we see not only provides that additional benefit, but also provides some retention where it may be that they have to work 5 years in order to vest. So there is a component there that we see some organizations like to use in order to ensure that the top talent stays. And then any other non-taxable benefits, make sure that you're analyzing whether whether it's reporting on the Form 990 or ensuring that it is. Do you provide a car allowance that may be taxable? Is the organization following the accountable plan rules and reimbursing employees for their business expense? So a few things just to take note of.
Is there anything else in the other non-taxable benefits that, might draw some scrutiny there? We know that, sometimes, obviously we know about housing, but car allowance, I've seen that. Is there any other things that we need to be thinking about? Maintenance of the housing or cleaning or anything like that?
Yeah, I mean, I think if it's the cleaning of the house, I mean, you do have to look at whether there's sort of the personal component to it. But I think as far as what a lot of organizations are thinking in the non-taxable benefits, some of the questions that are, if you look at Schedule J, that are getting to, is there any first class travel, any health or social club, is that provided? I think those are some of the questions that I think organizations are, because it's on the Form 990 and you have to report it. I think it's just things that may not be an issue, but could draw some scrutiny.
Great.
Matt, this is Martha. You may have already addressed this, but with tuition remission plans, there was a rather lively conversation on the NBOA forum about a school having been suggested by a trustee having suggested that if an employee was receiving tuition remission, they received less of a pay increase. So would that then compromise your entire tuition remission plan to be treating some employees differently?
I mean, to me, that sounds more like almost like a cafeteria plan where you have a choice between a taxable item and a non-taxable item. So I can either have taxable compensation or I can have the tuition remission. Generally, in those instances, you can't have that. So, I mean, 117 says if you have this plan, it's non-taxable. But generally, I mean, I can look at that a little bit deeper. But generally, if you have the option to choose essentially between a taxable and a non-taxable benefit, that often does taint the non-taxable. But happy to look into that further.
Okay.
Good.
Thank you.
Good.
Okay, so here's an area that I don't know will impact directly most schools, but wanted to make sure everyone was aware of it. Again, this was part of the 2017 tax reform, where it's the excise tax on excess compensation. So this really is any compensation in excess of $1 million paid to a covered employee, and generally this is wages, but there's a few adjustments as well. Organizations do need to track the 5 highest compensated employees in any of the years after 2016, even if they don't meet that definition, and then they need to be they'll be on that list of covered employees into eternity. The tax rate on that excess is 21. And I think this is, we've highlighted, consider 457 plan vesting events. I think for most schools, it would be sort of the abnormal situation that could cause this rather than just an individual compensated over $1 million. So I'll get to that on the next slide. And here's sort of this area that I think schools should just take a look at whether any of the severance arrangements in their contracts could cause an issue. Because in addition to simply taxing the excess of $1 million, there's a tax here on excess parachute payments. And that's essentially any severance payments that exceed 3 times the employee's average compensation over the previous 5 years, which they call the base amount. So an example of that would be if we had an employee who is making $100,000 a year average over that 5-year period. They've been a long-standing employee. let's say they've worked 40 years and upon leaving, they get a $400,000 payment for all of their work, all of their service. What this tax would say is, well, that's more than 3 times that base amount of 100,000. So we would say the 400,000 minus the 300,000, which would be the 3x, would be subject to the tax. So this would be an instance where the schools could be subject to this tax and not even realize it, kind of thinking it was just the $1 million tax, but it does encompass more than that.
Great. So we'll go into our third polling question now. So does your school have tax exempt financing for any of its buildings? Yes, we currently have tax exempt debt. No, we paid tax exempt debt of prior construction projects. No, we have not had tax exempt debt that I know of. I'll go ahead and give everyone just a few more seconds here. And we'll go ahead and close the polls. So it looks like most people fall between the yes, they have the debt, or no, they don't have any debt that they know of.
Okay.
Well, that was our leading question into our tax exempt financing issues. So the Tax Cuts and Jobs Act in 2017 changed Section 149D to eliminate tax exempt treatment of advance refunding bonds. This was the option that borrowers had to refinance their bonds and receive a big lump sum in advance of actually paying off the prior debt. So you could technically have outstanding, double your authorized outstanding debt in your possession for a certain period of time. And they've made it so that we can no longer do that. Most organizations who were receiving tax exempt financing in the last 10 years or so were doing it more on a construction draw type of basis. So it didn't really affect them very much, but the law did take away that potential option. But we see a lot more scrutiny and, it's harder to get the tax exempt funds out and to draw against them. You actually have to have already incurred expenses in a lot of cases. So we just kind of see a general tightening up of the availability of tax exempt money, both in advance during a construction project, because back in the day you could get the entire lump sum right up front. Maybe you would have some invested for a while because your project's going to take 2 or 3 years. Now they want you to actually incur the expenses before you can get it. So it kind of removes the opportunity to have excess debt outstanding at the same time, and also it takes away a lot of the problems with arbitrage that we had seen maybe in the decades prior when interest rates were higher. So that was one change in 2017. If we could move to the next slide. There are ongoing issues with tax exempt financing, however, that we want to make sure that we're bringing up to you. The main thing that we're looking at this year, as always, is private business use, which is under Section 150B. And private business use is defined as allowing a third party to use your tax exempt finance facilities in their own business purpose. So this is that situation where we have a campus that is bond financed, and during the summer we have a third party for-profit company that comes in and runs a summer camp and rents the entire exterior area and the auditorium or something like that. But because your tax exempt bond finance facility is being used by a third party in a business purpose, it is treated as private business use of an exempt finance facility. The compliance limitation there is that you can only have 5% over the life of your loan being used in private business use. So that requires us to really track how much is being used over the entire life of the loan. So every time we're asking you, can you give us a square footage allocation of how much space the people are using? That's what we're trying to track. And having more than 5% in any individual year is not a problem. It's just when we get to the very end and we're paying off the bond, we have to do kind of a look back over that 20, 30-year period. Say, did I keep the private business use under 5%? If so, phew, all good. If not, there's some pretty dire consequences where they can go back and say the entire tax exempt bond was not tax exempt retroactively, and then they require all of the bond holders to pay tax on the interest income that they received from that over the entire
Katie, that sounds really scary. You just said some really scary words right there, and that's
yes.
It is what it is. But let's kind of talk about this from a plain English high level perspective. So we know schools have taken out bonds to build a new wing, to do the new facility, the new performing arts facilities. And if you're saying, if the camp company comes in and they're saying, we're going to rent all of the outside and we're going to rent, whatever, this wing of classrooms, but those classrooms, those are not anything that was financed through the bond. Do we have an issue there? Like, I really want us to dive into this. What does 5% of the life of the loan mean? Like, let's dive in a little bit more here.
Yeah, so there's a couple ways that you can avoid this. One is, before you even start construction, you can do a debt versus equity allocation. So if I'm building a whole new facility and I think I'm most likely to rent out the theater and the auditorium, I can take the portion that I'm funding with my own equity and allocate it to the areas that I think are going to be rented more than the others. So, if I know my administrative offices and all of that are definitely never going to be rented out, that's the area where I would much rather allocate the tax exempt financing when we're doing the construction. That has to be done before the construction begins. It has to be set out and documented in order to be respected, but then it is treated as a separate facility for this purpose. So we don't have to look at those areas at all if they have been separately set aside as equity financed. And then as we're paying down the loan over the course of time, we get to take just the percentage that is loan financed. So, if after 10 years we've only got 50% left, we take whatever business use there is and multiply by 50%. So as the debt gets paid down over the years, you can have more and more private business use in the facility, and it doesn't have nearly as big of an impact. So in the beginning years, you'll probably have some pretty, you could potentially have some pretty high numbers, 10%, things in that in that range. And then as time goes on and you're paying down the debt, it could become very, very small. And we're looking at it again over the entire life of the loan, and that's where that 5% comes.
And Katie, when you say that 5%, what are we talking about? Income to what? I mean, what's the ratio that we're saying that is calculating this 5%? What is it?
Days of use. Days
of use. Okay.
Yes.
And it's not, and I think, so that's a big piece. So days of use. And if it's only, say the camp is only, from 8 to 11 every day in the morning, does that count as a full day, or is that like, 3/24 of a day?
So every day that you've got somebody in there counts as a full day. It doesn't matter whether the school also used it, even if the school used the area more than the other entity. Anytime you've got somebody in there using it for a business purpose, it's a full day count.
So really, documentation here of who's using what facility or what part of the school and what part of the school was debt financed is really going to be very important here.
Yes.
Is that fair to say?
Yes. Okay. Yes. And we try not to harass you too much every year on annual compliance, but we do ask a lot of questions around this when we see that people have.
Well, this is to keep you and the bondholders and everyone else just safe, right?
Yes. Yes. Making sure to protect the tax exempt status of the bond, because again, if at the end, and it's pretty uncommon that this happens, but at the end, if they were to say, oh, you failed your private business use test, the entire, the consequences are pretty crazy that it goes back so far, because everything becomes taxable at that point. And then if we do have a failure in private business use, the income that you generate from that can be taxable also. And they require that we pay tax on at least the fair market value of the rental. Not just, so if you're renting it to them at less than fair market value, you're going to end up paying tax on fair market value instead. And then there's no deduction for the interest paid on the loan when you're looking at expenses related to the rental. So it's not always common that we have taxability of the income generated by private business use, but it is a potential possibility. And so we look at that with you every year as well.
And
I think I have a little bit more on that on the next slide.
we have a few questions.
Yes.
As we expected.
Right, exactly, as we expected. So before we move on to the next slide, if we have an organization that rents the facilities only to other nonprofits, is that a problem for private business use?
Let's go to the next slide because it has the exceptions. Yes. All right, so our first bullet here, government or nonprofit use is specifically accepted from private business use, unless the nonprofit is using it in a UBTI activity, which again, it's business use, right? That's a UBI, is business income. But generally, a government or a nonprofit using it for program services is not going to be private business use. And then there are some incidental exceptions. So let's say they're using the facility on the same basis as it's available to the public. So I have an example here of teaching swimming lessons at a public pool. The arrangement has to be limited to 200 days or less, and then there's an exception for it. So as long as they're not getting any special access. The third bullet there, incidental non-possessory use. So for example, we have a rental income because we have a company that put an ATM or a vending machine or a cell tower on our building. Because they're not actually taking possession, they're just leaving their item or their kiosk or whatever, that is not considered to be private business use either. And then there are a couple of temporary use exceptions where if your total term, including renewal options, is 100 days or less, and it would be available to the public on the same basis, except for that it's too expensive. So again, this is probably not something that's going to happen, but maybe I'm trying to think of what could possibly happen that would be in a school context. So this one probably doesn't apply, but the other one, the second one there, total term including renewals is 50 days or less, arm's length negotiation at fair market value for rent, and the facility is not primarily built for the external business use. So it was built for your uses, but your total term is 50 days or less and it's fair market value. There is a short-term temporary use exception there. So if you can qualify under one of those, then we don't have to count those days of use as private business use, and we don't have to add them to our 5% calculation.
And Katie, here's another question, likely in that temporary use, but what if a school has tutors that tutor the students? They do it on campus, but the school doesn't charge the tutor anything. Does that mean to count?
So I think in that case, we would probably be on the, using it on the same basis as it's available to the public. So you'd want to have it limited to 200 days or less per year. Or I'm sorry, the overall. So generally, if they're making money on the tutoring, they should not really be doing it in bond financed areas. Again, this is something that is unlikely to, there's not bond investigators out there wandering the hallways of your school to make sure that there's not a college student tutoring some high school students. They're looking for more, business use where a company or it could be a sole proprietor, but if you're using bond finance facilities that are only authorized for specific educational purposes and they're using it for something else to make money, that is exactly what they're looking for. So while there's no bond police out there, you wouldn't want to have like a for-profit test prep company come in and be teaching test prep in a section that is bond finance, for example, because you're probably going to have that going on for much longer than 50 or 200 days. And then our last thing on tax exempt financing is arbitrage. So if you end up investing any of the bond proceeds and end up making more investment income than the rate of the bond, you have to pay back the difference to the IRS. And we're required to look at that every 5 years and pay any rebate due. We can pick our own schedule, but it does have to be every 5 years after issuance. And then there are some exceptions to rebate for spending the loan proceeds quickly for their intended exempt purpose, so for your construction. And there are different arrangements where if you've completed within 6 months, 18 months, or 24 months, you'd from taking the funds and spending it, you don't have to worry about arbitrage. So that's your exception. And I think most of our schools are in that situation there.
Great, thanks, Katie. We'll go into our last polling question here in just a moment. And as a reminder for the group, you are going to receive the slides and the recording within the next 48 hours. So our last question is, which of the following would be considered private business use for the tax-exempt finance facilities? Rent classroom to the city for a polling place on election day, rental income from a red box installed on campus all year, renting the auditorium at fair market value to Armanino for a day conference, renting the campus at fair market value to a production company for 30 days, or none of the above. We'll give everyone just a few more seconds here to get their answers in.
This was my tough question.
Traps everywhere. That's all I see. Traps everywhere. I'm uncomfortable.
Okay, and we'll go ahead and close the polls. See how everyone did.
Oh boy.
And it was none of the above. So everybody who picked none of the above, good job. All of these qualify for an exception.
That's good. It just showed. Go ahead, Katie.
Yeah, it just does go to show you there's a lot of different ways that you can generate revenue in a bond finance facility that doesn't violate any of the exceptions.
Great.
So moving on to 529 plans. So hopefully most of you are familiar with the 529 plans. They've been around for a while, but basically what they do is allow taxpayers to put money, set money aside. The growth is not taxed, but it has to be used for qualified higher education expenses. But what happened was 529C7 was amended to allow up to $10,000 per student per year to be withdrawn for K through 12 tuition expenses, which is good news for private schools. Gives the parents and students another way to help pay for that education. The caveat is on the next slide. So state conformity issues. California does not conform, and essentially what there would be is a penalty of 2.5% on the earnings. And so this could be an area where perhaps in California it limits the use of the 529 for education. Some individuals may take advantage of it. Others may just wait to see what happens and whether the California legislature is able to override.
All right, and then our last topic here, this was one that changed last year as well. The Schedule E racial non-discrimination policy disclosure requirements changed to allow online posting, so you don't have to put it in the newspaper or on TV anymore. There are some.
That's a win.
Yes, it's. I mean, I think we've all probably had it there, but now it counts.
Welcome to 2020.
Yes, exactly. So the requirements are that it has to be on your primary landing page and available at all times, and you have to reasonably expect visitors to notice it. So it can't be of a color, size, or graphic treatment that makes it so tiny or invisible that nobody can see it. You have to think, is it unavoidable? Do other parts significantly detract from it? And can you see it without the visitor having to do anything other than scroll? So they specifically say, a link on the homepage that takes you to another page where the policy is shown does not qualify. And then a notice that appears in a carousel where it's flipping around with a couple of other items, or in a drop-down menu, or if you have to hover over it in order to see it, none of those are going to qualify. So it has to be out there. It has to be impossible to miss. And so the example here comes from the instructions, and this is an example of a statement that it says will qualify. It covers everything that it's supposed to cover, but the requirements are really that it says in your charter, bylaws, or other governing instrument, or in a board resolution that you have a racially non-discriminatory policy as to students, and that it doesn't affect applicants or students in the way that policies or admissions are carried out. So this is an example, and it is in the instructions to Schedule E, and you can use that statement word for word if you would like.
And this is Martha. This is particularly applicable to Cal-ISBOA schools because we have been publishing this as a group notice in several newspapers of record and will no longer be doing that because it is our position that it is much more meaningful and more obvious to interested parties to have it on your website. So we have been trying to alert you all to this since Katie alerted me to this change in May of last year. So if you have any questions about it, you can certainly contact me. And the other thing that I've gotten a lot of questions about this, and one of the misconceptions is that it's okay to have it on your main admissions page. And as Katie just said, that's not okay. Interested parties are not limited to people applying to your school. It needs to be on the home page. So if you have any other questions, either ask your auditor or I can point you in the right direction. So anyway, this is a really important one for Cal-ISBOA members.
Yes, thank you. And I also wanted to remind you that you do have record keeping requirements about the data that your school has, because there is a burden on the school to demonstrate that not only does it have this policy, but that it follows this policy. So they want you to keep records unless you're providing this same data to another federal or state agency on at least an annual basis, which on the 990, you don't provide this much detail. So you would need to keep these records, and if the IRS requested them, you would need to be able to provide them. So records indicating the racial composition of the student body, faculty, and administrative staff for each academic year, records sufficient to document that scholarship and financial assistance is not discriminatory, and then they want you to keep copies of all your brochures and catalogs and advertising dealing with student admissions programs and scholarships, and on materials used to solicit contributions. So this policy was written in the 60s after integration of schools, and it's designed to prevent people who wanted to keep segregated schools from going and creating a private school that is essentially still segregated. So in order to qualify for tax exemption, the IRS says, well, that's fine, but you have to prove to us that you actually are not discriminating on a racial basis. So we do have some schools that because they are not taking it into consideration, don't think that they need to keep records. They do want you to actually keep records of the school's performance on who's attending and who is being hired. And they say, diversity on the staff and administration level indicates is an indice of a non-discriminatory approach to hiring and admissions. And then they want to make sure that any kind of financial aid and other benefits are being applied equally. And so the record keeping is something I think a lot of people don't necessarily consider, but that is required. And then we just have a couple of last minute reminders. The Taxpayer First Act, which came through July 1st of 2019, introduced mandatory e-filing. We already kind of had mandatory e-file for 990s if you had 250 returns per year or more. So if you had a lot of W-2s or 1099s, you already had to. The 990T is going to be new. The IRS doesn't actually accept it in electronic form yet. So they're kind of in a hurry to get that ready because we have a 2-year transition period. The other item is the IRS is now required to provide notice if you are at risk of auto revocation. So if you fail to file your 990 for 2 years, they're required to send you a notice and say, hey, we haven't received you for 2 years. If you miss another year, you'll get revoked. In the past, that had not been going out and you would just suddenly find out you were revoked. And then a quick election year reminder. 501c3 organizations can't be involved in political campaign activities. So you can't be saying anything for or against any candidates for elected office. Just don't say anything about candidates at all. You can attempt to influence the outcome of specific legislation, and that is lobbying, but that can't represent a significant part of your expenses or your activities, and it is disclosed on the 990 how much you spent and what it was for. So for legislation, we can be involved a little bit. For candidates, we can't touch it. So just a reminder as we're getting into a probably pretty heated election year.
Awesome. Thank you everyone for joining our webinar today. We're right at the end of time. Katie, Matt and myself will be doing a tax update at MBOA in Orlando. Please feel free to join us there as we dive into even more topics on a national level. If you have any questions, please come see us there. Please reach out. And like Katie said, we'll also see you in May. So thank you so much.